Welcome back to the Financial Menagerie. Like a lot of shows, we took a late summer hiatus as the CFA Society moved into their new offices. But now we're back to talk about where the markets are and where we think they might be going. In this chart, you can see that the 10-year Treasury yield really hasn't moved very much since the middle of the summer. So basically, since the beginning of July, it's bounced around in a fairly narrow range. And that range has been narrowing over the last few weeks. This chart shows the Treasury yield curve in a few points over the last couple of months. And you can see that in the dark lines on August 25th and September 24th, the curves are roughly in the same place with the possible exception of the yield on the 30-year Treasury. This chart shows the spread between different points in the yield curve over the last couple of years. And you can see that the thin line, which shows the 2 10-year spread, really hasn't changed very much over the past month or so. What has changed a bit is the spread between the 5 and 30-year Treasuries. That spread has widened out as the 5-year has outperformed and the 30-year has lagged the market. The realized volatility of the Treasury curve has started to pick up again after dropping late this summer, as you can see in this chart. The following chart also shows something interesting, the volatility of volatility, and you can see that that's picked up over the past year or so, whereas it was pretty stable in 2014. For most of 2015, it's been elevated. You can see in this chart that the gamma-vega ratio in the swaptions market, which we discussed a few episodes ago, has backed off a little bit. That's the ratio between short and long-term, long expiry implied volatilities, and it generally picks up during times of market nervousness. So you can see that this indicates that the market's nerves have been somewhat calmed over the past few weeks by a lack of events in the market, if you will. The U.S. equities market had a big drop over the course of the summer. You can see from this chart that the Dow Jones Industrial Average, which is the most widely quoted, if not the most market-inclusive measure, is basically back where it was at the beginning of 2014. This chart is indexed to January of 2014, so you can see that the market really has been on a round trip to nowhere. The S&P 500 and the NASDAQ are ahead of where they were, but still had a big drop over the course of the summer with the market volatility in Europe and in China. And speaking of China, this chart shows the Shanghai index, and you can see how it stabilized a bit, even though it remains very volatile, as you can see in the dotted red line, which shows the standard deviation of the index. The biggest news over the last couple of weeks is that there was no move by the Fed to raise their funding rate at the September 17th meeting. Now we're back to waiting for what they do at the October 28th meeting. And while Yellen's recent comments, or Janet Yellen's recent comments, suggest that they're ready to move, we've heard that before. This chart, which shows the Fed funds implied futures rates, shows that the market is not a believer in this scenario. It shows a less than 60% chance of a rate move at that October 28th meeting. One interesting aspect of the last meeting's release was that it also included their quarterly dot plots, which show where the various Fed members think that rates, quote unquote, should be at various year ends as well as in the long term. You can see in this chart, which shows the Eurodollar futures curve as well as the high, low, and median forecasts, that one member, it's not clear who, but the thinking is that it's the very dovish Fed president of the Minneapolis Fed, thinks that rates should be negative at the end of 2015 and 2016. Now, part of it's interesting is that it's not clear what the definition of where rates should be means. Is it predictive or is it prescriptive? But it's interesting to note that, as well as the wide dispersion in rate forecasts, even going out past the 2017 year end. Well, what's interesting in this discussion of the Fed policy moves and potential moves in the market is that a lot of people talk about traders these days don't know how to trade in a market where rates are going up. So let's discuss that a little bit. This chart shows the spread of the 2-year Treasury yield to the Fed funds implied rate. Actually, it's the Fed funds effective rate, excuse me. And it shows it over time. And what's interesting is that banks watch it very closely because it's a really critical measure of short-term profitability, especially for banks that are investing in securities that they're funding by taking out debt or deposits. Now, this chart shows similar information, but it also shows the Fed funds effective rate over the same period of time. And you can see that there's been several regimes since early 1993, a period where a lot of traders from my generation learned to trade rising rates. During the 94 tightening regime, you can see that the yield spread gapped wider as the market kind of overshot what the Fed was going to do and over-anticipated it. The yield curve actually inverted for a time until into, if memory serves, the spring of 1995. During the 1998 long-term capital markets crisis, the spread went negative as the market anticipated the Fed moving faster than they actually did. It's also interesting that the spreads tend to go negative during protracted rate increases starting in 2004. Not clear why, but the market did rally, possibly anticipating Fed moves, again, a little early for some investors. Finally, the spread has widened out over the past few years, again, taking advantage of the fact that investors think that the Fed is poised to raise funding rates, even though they haven't moved over the past few years, despite speculation. Now, this chart shows the same Fed funds effective rate, but against some of the equity indices we looked at before. And you can see that the relationship is somewhat different. There's not a direct effect on equity markets, the same as you see in short-term treasuries, but you do see some tendencies. And one of those is that the markets tend to rise during periods of rising rates. And I interpret it as the market basically viewing Fed rate increases as a sign of confidence in the economy. Now, it's difficult to quantify that. The correlations are not that clear, but I would tend to view the Fed's moves and funding rates as a general indicator of economic activity and strength with respect to stocks, rather than having a direct effect on the value of them as you see in the bond markets. Okay, finally, we're going to talk about a few things in our cultural segment. Think of it as champs and chumps, heroes and zeros, etc. And we'll do the chumps first. And chump number one is my favorite candidate, Mr. Trump. Okay, Donald, on the one hand, you're ahead in the polls. People seem to like some of your messages. I'm not going to opine on that. But what I will say is I would urge you to stop attacking journalists that ask you tough questions. Megyn Kelly is denigrated as a bimbo, and because you confuse Kurds and Kuds from Hugh Hewitt, you went on and said he's a third-rate radio announcer. Now, frankly, I don't think Donald Trump knows the difference between the Kuds and the Kurds and being Kurd. But in fact, he's a candidate for president, and it's silly and unworthy of someone who is going to have the most powerful office in the world. As Harry Truman said, if you can't stand the heat, get out of the kitchen. So I'd urge you to answer the questions the best you can and not attack the journalists asking them. Now, another thing, anybody that watches football now is inundated, and I do mean inundated, with stupid commercials by the weekly fantasy football sites. I think one of them is FanDuel's and the other is DraftKings. And in my view, first of all, the commercials are incredibly dumb and abusive. Pick your players, pick up your cash, etc. But more practically, it's gambling. I have no idea why they think they can drive a dump truck through this loophole that was put through a few years ago, which basically banned online gambling with the exception of fantasy football, because it's supposedly this friendly activity that's carried on among neighbors and friends. Turning it into gambling, I think, is an enormously bad idea, because there's really no difference between betting on games and betting on card games. And it's just, I view it as a really bad sign. I expect this loophole to be closed. So I think it's going to be a very bad investment for the networks that have already poured a lot of money into this, this new transmogrification of fantasy football.
Wallace, what happened? You were good last year. Huge disappointment. Huge. Especially you, Martinez. You know why. But you know what, guys? Don't worry about me. I'm gonna have a whole new team next week. Yeah, very excited. Henderson, you're coming with me.
Wish you could walk out on your fantasy team. FanDuel packs the thrill of a whole season into just 1 week. Play in 1 week fantasy football leagues for real money with immediate cash payouts.
Now, as far as the champs of the week, it's a little painful for me to actually say this. I've been a Jets fan since the late 1960s. Okay? But I really did enjoy the film that was put out by the NFL networks on the Patriots Super Bowl season last year, Do Your Job. It was really well done, and you can see why they've been so good for so long and why Bill Belichick is such a good coach and has such an outstanding record, even though he was the coach of the Jets for a day. But on the other hand, you know, I always think that you can hate someone, as I hate the Patriots as a football fan, but you also respect what they do, respect how good they are, and try to learn from them.
It's a quick throw. Look, throws inside. Pass is. Oh my God! No! We just need everybody to do their job.
Maybe the one word that isn't in that's implied is do your job well.
Okay, that's the show. Join us next time in the Financial Menagerie.